What is income investing? Income investing is a strategy focused on building a portfolio that generates regular passive income through dividends, interest payments, and other distributions. Unlike growth investing, which prioritizes capital appreciation, income investing aims to create steady cash flow. With income investing, you don't need to sell your assets to generate cash flow, which is a key advantage. Income investing focuses on assets that provide regular payments, such as dividend stocks, bond interest, and real estate investment trust distributions. These investments create a steady cash flow that investors can use for living expenses or reinvestment. This approach is particularly popular among retirees and those seeking financial independence without needing to sell their investment assets. Income investing helps you build wealth while also providing the regular cash flow you need for your financial goals. Income investors have several asset classes to choose from, each with unique characteristics. Dividend-paying stocks are shares of companies that distribute a portion of their earnings to shareholders. They offer both regular income and potential for capital appreciation. Companies usually pay dividends quarterly. Those with a history of increasing dividends are particularly attractive for income investors. Bonds are debt securities where you lend money to an issuer for a defined period. They provide fixed interest payments and return of principal at maturity. Treasury bonds are backed by the government. Corporate bonds offer higher yields with greater risk, and municipal bonds may provide tax advantages. Real estate investment trusts, or REITs, own, operate, or finance income-producing real estate. They allow investors to earn dividend-like income from real estate without buying property directly. REITs must distribute at least 90% of their taxable income to shareholders annually, resulting in higher yields compared to many other investments. Master Limited Partnerships, or MLPs, are publicly traded partnerships primarily involved in energy infrastructure such as pipelines and storage facilities. MLPs offer high distribution yields and tax advantages, but come with more complex tax reporting requirements and potential exposure to energy sector risks. Preferred stocks are hybrid securities with characteristics of both stocks and bonds. They pay fixed dividends before common stockholders receive any dividends. While preferred stocks offer higher and more reliable dividend payments, they typically have limited growth potential and don't carry voting rights. Certificates of deposit, or CDs, and money market accounts are among the safest income investments, often backed by FDIC insurance up to $250,000. While they offer lower yields compared to other income investments, they provide predictable returns with minimal risk, making them suitable for conservative investors or short-term goals. When comparing income investments, we typically see a correlation between yield and risk. Lower risk options like CDs offer safety, but lower returns. Higher yielding investments like preferred stocks, dividend-paying stocks, REITs, and MLPs offer greater income potential, but carry more risk. When building an income portfolio, consider your specific needs, time horizon, and risk tolerance. Diversification across multiple income-generating assets helps balance higher-yielding investments with more stable options. It's also important to understand the tax implications of different income sources, as they can significantly impact your effective yield. Dividend stocks are cornerstone assets for income investors. These companies share a portion of their profits with shareholders in the form of dividends. Look for companies with a history of consistent dividend payments and increases. Dividend aristocrats are companies that have increased their dividends for 25 or more consecutive years. Focus on dividend yield, which is calculated by dividing the annual dividend per share by the current share price. This gives you the percentage return on your investment from dividends alone. However, beware of unsustainably high yields, often called yield traps. An unusually high yield may signal that the market expects a dividend cut or that the stock price has fallen significantly. Evaluate the dividend payout ratio to ensure the company isn't overextending itself. This ratio shows what percentage of a company's earnings are paid out as dividends. A lower payout ratio indicates that the company has room to grow its dividend and provides a safety buffer during economic downturns. Certain sectors traditionally offer more reliable dividends even during economic downturns. These include utilities, consumer staples, healthcare, and telecommunications companies. These sectors benefit from stable cash flows and defensive business models that are less sensitive to economic cycles. To summarize, when investing in dividend stocks, look for companies with consistent payment histories, evaluate dividend yields carefully, check payout ratios for sustainability, and consider defensive sectors for reliable income. Bonds are debt securities where you lend money to an issuer, like a government or corporation. When you buy a bond, you're essentially providing a loan. In return, you receive regular interest payments, known as coupons, and get your principal back at maturity. Let's explore the main types of bonds available to income investors. Government bonds, including U.S. Treasuries, offer the highest safety but typically lower yields. They're backed by the full faith and credit of the issuing government. Corporate bonds provide higher yields but come with greater credit risk. The stronger the company's financial health, the lower the risk, but also the lower the yield. Municipal bonds are issued by state and local governments. Their key advantage is tax benefits. Interest is often exempt from federal income tax, and sometimes state and local taxes as well. Bond laddering is a strategy where you buy bonds with staggered maturity dates. This helps manage interest rate risk while maintaining some liquidity in your portfolio. For example, you might build a 5-year ladder by investing equal amounts in bonds maturing in 1, 2, 3, 4, and 5 years. As each bond matures, you reinvest the proceeds in a new 5-year bond, maintaining the ladder structure. This way, you're regularly capturing current interest rates while having a portion of your money becoming available each year. Let's look at the current bond yield environment. In recent conditions, yields have been relatively attractive compared to the past decade. U.S. Treasury bonds are yielding between 3.8 to 4.5% depending on maturity, with longer terms generally offering higher yields. Corporate bonds provide higher yields with A-rated bonds around 5.2% and BBB-rated bonds, the lowest investment grade, offering up to 6%. Municipal bonds typically yield less than comparable corporate bonds, around 4% for AAA-rated munis, but their tax advantages can make their effective yield higher for many investors. Let's recap the key points about bond investing for reliable income. Bonds provide reliable income through regular interest payments. Government bonds offer safety, while corporate bonds offer higher yields with corresponding risk. Municipal bonds may provide tax advantages for many investors. Bond laddering is a useful strategy to manage interest rate risk while maintaining some liquidity. In the current environment, bond yields range from about 4% for government bonds to 6% for lower-rated corporate bonds. Real estate investment trusts, or REITs, allow investors to access real estate income without directly owning property. REITs are required by law to distribute at least 90% of their taxable income to shareholders annually. This distribution requirement results in higher yields than many other investment types. REITs come in several different categories. Residential REITs focus on apartment buildings and single-family homes. Commercial REITs invest in office buildings, shopping centers, and other retail properties. Healthcare REITs specialize in hospitals, medical offices, and senior living facilities. Mortgage REITs are unique as they don't own properties directly, but instead finance real estate and earn income from interest on those investments. REITs provide valuable portfolio diversification because they often move differently from stocks and bonds. When it comes to income, current REIT yields average between 3 and 5%, which is higher than many traditional investments. The S&P 500 yields approximately 1.5%. The 10-year Treasury yields approximately 2.0%. The REIT's average yields approximately 4.0%. The specialized REITs yields approximately 6.0%. Some specialized REITs, particularly in sectors like data centers or cell towers, can offer even higher distributions, making them attractive for income-focused investors. Building a diversified income portfolio is essential for long-term financial stability. Diversification is crucial in income investing because it reduces risk and helps stabilize your income streams. To build a robust income portfolio, diversify across different asset classes, sectors, and geographic regions. A well-balanced income portfolio might include approximately 40% dividend stocks, 40% bonds, 15% REITs, and 5% cash equivalents. This balanced approach creates multiple income streams that provide stability while still capturing growth opportunities. Over time, your portfolio will drift from its target allocation as different assets perform differently. Regular rebalancing, typically once or twice a year, helps maintain your desired allocation and risk profile. One of the key benefits of diversification is protection during market challenges. When certain sectors face difficulties, a diversified portfolio continues to generate relatively stable income. This protection helps ensure consistent income even when individual investments underperform. Remember these key principles when building your diversified income portfolio. Spread investments across multiple asset classes and sectors. Consider your personal time horizon and risk tolerance. Rebalance periodically to maintain your target allocation. And remember that diversification helps protect your income when certain sectors face challenges. Understanding the tax implications of your income investments is crucial for maximizing your returns. Different income sources are taxed at varying rates, which can significantly impact your net returns. Qualified dividends and long-term capital gains enjoy preferential tax rates of 0, 15, or 20%, depending on your income level. Bond interest is typically taxed as ordinary income, which can be as high as 37% for high-income earners. Municipal bond interest offers a significant advantage, as it's often exempt from federal taxes and sometimes state taxes as well. REIT dividends are generally taxed as ordinary income, making them less tax-efficient in taxable accounts. Let's take a closer look at the preferential tax treatment for qualified dividends and long-term capital gains. For single filers, in 2023, the 0% rate applies to incomes up to $44,625. The 15% rate applies to incomes from $44,626 up to $492,300. And the 20% rate applies to incomes above $492,300. High-income investors should also be aware of the additional 3.8% net investment income tax that may apply. Municipal bonds offer unique tax advantages that can make them attractive for investors in higher tax brackets. To compare municipal bonds with taxable bonds, we calculate the tax equivalent yield. For example, a 3.5% municipal bond in a 37% tax bracket is equivalent to a taxable yield of about 5.56%. Strategic placement of investments across different account types can significantly improve your after-tax returns. Tax-efficient investments like qualified dividend stocks and municipal bonds are better held in taxable accounts, while tax-inefficient investments like corporate bonds and REITs are better held in tax-advantaged accounts like IRAs and 401ks. Tax loss harvesting is a strategy that can help offset capital gains and reduce your tax liability. By selling investments that have declined in value, you can realize losses that offset gains in other investments. For example, a $2,000 loss can offset a $2,000 gain, potentially saving you $400 in taxes at a 20% rate. Let's summarize the key tax considerations for income investors. Income investors must adapt their strategies to changing economic conditions. During high inflation, your investment capital loses purchasing power over time. Treasury inflation protected securities, or TIPS, provide direct protection because their principal adjusts with inflation. Floating rate bonds also perform well as their interest payments adjust higher with rising rates that often accompany inflation. Companies that can consistently grow dividends often have pricing power to pass inflation to customers. In a rising interest rate environment, bond prices generally fall, but short duration bonds are less sensitive to rate increases. Long duration bonds suffer more price depreciation than short duration bonds when rates rise. Financial sector stocks often benefit from rising rates, as banks can earn higher net interest margins. During recessions, defensive dividend stocks tend to outperform the broader market. Consumer staples companies sell essential products that people need, regardless of economic conditions. Utility companies provide essential services with regulated returns, making their dividends more reliable during economic downturns. Healthcare companies also tend to maintain steady revenue regardless of economic cycles. Currently, interest rates are higher than they've been in several years. This creates a more favorable environment for bond investors who can now earn more income from their fixed income investments. After a long period of historically low yields, investors now have more options for generating income from traditional fixed income investments. Common mistakes in income investing can significantly impact your returns. Let's explore the major pitfalls to avoid. A common mistake is chasing yield without considering risk. Extremely high yields often signal underlying problems with the investment. A 20% yield might look attractive, but usually comes with much higher risk compared to more moderate yields. Many investors neglect inflation's impact on fixed income. Over time, this erodes the real value of your returns. This chart shows how inflation reduces the real value of a fixed income stream over time. Overconcentration in just a few investments increases your vulnerability to market shocks. A diversified portfolio provides better protection against market shocks than a concentrated one. Some investors focus only on yield while ignoring total return, which includes both yield and capital appreciation. Looking at total return gives you a more complete picture than just focusing on yield. As your life circumstances change, your investment strategy should adapt accordingly. Your asset allocation should shift more toward income as you approach and enter retirement. Even seemingly small fees can significantly reduce your long-term returns. This graph illustrates how a seemingly small 1% annual fee dramatically reduces your returns over 30 years. Selling quality income investments during market volatility is counterproductive when they continue to generate income regardless of price fluctuations. Notice how income remains stable even when prices fluctuate. Selling during price dips means losing that consistent income stream. Let's recap the 7 critical mistakes to avoid in income investing. Being aware of these pitfalls will help you build a more resilient income portfolio. By avoiding these common mistakes, you can significantly improve the performance of your income investments. Let's get started with income investing by defining your income needs and risk tolerance. Before investing for income, you need to clearly define your goals by answering some key questions. A great way to start is with dividend ETFs, which offer instant diversification. Let's look at 2 popular options, SCHD and VYM. For stability, consider adding bonds to your income portfolio. You can choose between bond ETFs like BND or individual treasury bonds through treasurydirect.gov. If you don't need immediate income, consider setting up a dividend reinvestment plan, or DRIP, to compound your returns over time. Once your portfolio is set up, it's important to monitor key metrics that indicate how well your income strategy is performing. It's best to start with a simple portfolio of 1 or 2 ETFs, then gradually increase complexity as your knowledge and confidence grow. Finally, remember that successful income investing requires patience and a long-term perspective. Your dividend income can grow substantially over decades through the power of compounding and dividend growth. By following these steps and maintaining a disciplined approach, you can build a portfolio that generates reliable income for years to come.